portfolio performance and measurement. We all know that in this lesson we will discuss the Sharpe's model of performance measurement, describe the Trainer's model of performance measurement, and describe the Jensen's model of performance measurement. After going through this presentation, you should be able to define benchmarking, discuss the Sharpe's model of performance measurement, describe the Trainer's model of performance measurement, explain the Jensen's model of performance measurement. Benchmarking gives us a reference point for comparison and also helps in comparison of return and risk. The most important consideration for portfolio performance measurement is the benchmark choice. All portfolio evaluation is dependent on benchmark choice. Make sure the benchmark is unambiguous, is an investable index, and it has a measurable value. Make sure the benchmark is appropriate for the style of portfolio that you are evaluating. The internal rate of return that equates the initial contribution and the cash flows that occur during the period with the ending value of the fund is the dollar-weighted rate of return. Mathematically, this measure of return is the dollar-weighted average of sub-period returns with the dollar weights equal to the sum of the initial contribution and all the cash flows up to the time of the sub-period return. Let us suppose a portfolio has a market value of rupees 100 lakh. In the middle of the quarter, the client deposits rupees 5 lakh, and at the end of the quarter, the value of the portfolio is rupees 103 lakh. What is the dollar-weighted return? The dollar-weighted return would be calculated by solving the following equation for R. 100 equals to minus 5 divided by 1 plus R plus 103 divided by 1 plus R into 2, where R equals to minus 0.98%, which is a semi-quarterly rate of return. This can be converted into a quarterly rate of return by adding 1 to it, squaring this value, and then subtracting 1 from the square, resulting in a quarterly return of 1 plus minus 0.0098 into 2 minus 1, which equals to minus 1.95%. This time-weighted rate of return is the weighted average of the internal rates of return for the sub-periods between the cash flows, and it is weighted by the length of the sub-periods. Suppose Fund A has rupees 10 lakhs under management at time 0. It earns 25% in period 1. At that time, rupees 5 lakh is pulled out by the investors. The remaining capital earns negative 10% during period 2. What are the fund's time-weighted and rupee-weighted rates of return? The time-weighted rate of return is calculated as a geometric mean of the individual rates of return. Thus, the time-weighted performance is 1.25 into 0.90 to the power of 0.5 minus 1 equals to 0.0607, which equals to 6.07%. The rupee-weighted rate of return is found as the solution to the internal rate of return problem. Rupees 10 lakh equals to rupees 5 lakh divided by 1 plus R plus rupees 6,75,000 divided by 1 plus R into 2, where R equals to 10.88%. Trainer's measure basically gives us a measure of return per unit of market risk or systematic risk that our investment earns. Strictly speaking, the larger the trainer's measure, the better. However, we would like to have some benchmark with which to compare our individual trainer's measures. If TI is greater than TM, the portfolio would plot above the security market line, indicating superior performance by the portfolio manager. If TI is less than TM, the portfolio would plot below the security market line, indicating poor performance by the portfolio manager. The Sharpe measure gives us a measure of return per unit of total risk. Again, the higher the Sharpe measure, the better the performance. We can also compare individual Sharpe measures to a benchmark. Instead of plotting deviations from the security market line like the trainer measure, we are plotting deviations from the market, determined price of risk as defined by the capital market line CML. If SI is greater than SM, the asset earns more than the risk premium required by the capital market line, indicating superior performance by the portfolio manager. If SI is less than SM, the asset earns less than the risk premium required by the capital market line, indicating poor performance by the portfolio manager. Jensen's alpha is based on the ideas contained in the CAPM. It, like the trainer measure, measures how well a portfolio manager does at dealing with systematic risk. Alpha measures the degree to which managers are earning significant returns after accounting for market risk, as measured by beta. If the manager is earning a fair return for the given portfolio's systematic risk, then alpha would be 0. Plus alpha indicates good performance and minus alpha indicates poor performance. Jensen's alpha allows us to statistically test whether the return the manager earns is significantly more or less than what we would expect using the CAPM. Jensen's alpha allows us to get a performance measure that incorporates information from more than one time period. The validity of the Jensen performance measure is tied to the validity of the CAPM. Thus, some individuals will choose estimate Jensen's alpha performing the regression model without subtracting the risk-free rate. This gives us the alpha from the characteristic line. Its interpretation is the same as the interpretation of Jensen's alpha. Analyze two portfolios having the following characteristics. Portfolio reliance. Observed return 0.18. Beta 2.0. Residual variance 0.03. Portfolio Satyam. Observed return 0.12. Beta 1.5. Residual variance 0.00. The risk-free rate is 0.07. The return on the market portfolio is 0.15. The standard deviation of the market is 0.06. A. Compute the Jensen index for portfolio reliance and Satyam. B. Compute the Sharpe index for the market portfolio. C. Compute the Sharpe index for portfolio reliance and Wipro. D. Compute the trainer index for the portfolio's reliance and Satyam. A. Jensen index. Here return on reliance is 18%. RF risk-free rate if 7%. RM equals to 15% and beta is 2.0. Put values in formula. Portfolio reliance 18% minus 7% plus 15% minus 7% into 2.0 equals to 18% minus 7% plus 8% into 2.0, which equals to minus 5%. Portfolio Satyam 12% minus 7% plus 15% minus 7% into 1.5 equals to 12% minus 7% plus 12% equals to minus 7%. B. Sharpe index for market. Here RM is 15%, RF is 7% and standard deviation is 6%. Put value in formula. RM minus RF divided by standard deviation. 15% minus 7% divided by 6% equals to 1.33%. C. Sharpe index for portfolios. Standard deviation of portfolio reliance equals to 2.0 into 2 into 0.0036 plus 0.03 to the power 1 by 2 equals to 34.98%. Sharp index for portfolio reliance equals to 18% minus 7% divided by 34.98% equals to 0.315. Standard deviation for portfolio Satyam equals to 0.09 equals to 9%. Sharp index for portfolio Satyam equals to 12% minus 7% divided by 9% equals to 0.55. D. Trainer index portfolio reliance 18% minus 7% divided by 2.0 equals to 5.5. Portfolio Satyam 12% minus 7% divided by 1.5 equals to 3.33. Now let us check if we have understood the various concepts discussed in this lesson clearly. Performance attribution analysis is a means of evaluating an investment manager's performance, the return and the sources of return relative to a benchmark portfolio. Right or wrong? Right. Sharp measure is an absolute measure of performance adjusted for risk. Right or wrong? Wrong. The Jensen's measure evaluates the portfolio manager on the basis of both rate of return and diversification. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied so far. The investment manager will be bound to the investment policy and subject to a constant evaluation of his achievements. His achievement will be the return on the capital the investor provided. Benchmark portfolio is a tool for the performance evaluation of a portfolio manager. Sharp measure evaluates the portfolio manager on the basis of both rate of return and diversification. Jensen's measure is an absolute measure of performance adjusted for risk. Trainer's index is the slope of a straight line going through the risk-free rate of return. The trainer's index may also be defined as the risk premium earned per unit of risk taken, where beta is the risk measure.